Love it or loathe it, as an investor, you simply can't ignore it. Digital currencies, blockchain, smart contracts, NFTs, Web3 and more. We want to understand and explain the entire ecosystem, which is evolving by the day. We'll talk to the developers and investors in the ecosystem to find out where the opportunities are. Join me for Cracking Crypto, weekdays only on ausbiz.
Cracking Crypto is partnered with City Index. Trade shares, CFDs, Forex, crypto and more with a trusted provider.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
G'day and welcome to The Call. 10 stocks picked by you, 2 experts, 1 hour. It is Friday, the 1st of April. Yes, April Fools. I'm Andrew Gagan. Great you can join us. Our 2 experts on the show here today, Luke Winchester from Merewether Capital and Claude Walker from A Rich Life. Welcome to both of you guys. Luke, end of quarter, 3 months down already, and taking a look at the Australian share market, actually outperformed, certainly compared with global markets.
Yep.
What about the world of small caps?
Probably not as much, and that's, small caps more volatile. The liquidity becomes a problem. But that being said, Aussie small caps, similar to the Aussie broader index, that heavy materials weighting has really kept us instead. I think the small ords index was up 5-point-something% for March alone. So you've seen that big recovery at an index level. It's a really interesting market at the minute. Like you take a step back, and depending on what type of manager or investor you are, you could be doing really, really well or really, really poorly. There's big divergence in sectors, in styles of investing, and the macro overlay is really interesting as well. I mean, I sat back at that budget the other night and thought it was a really interesting budget for where we are in the cycle and where the economy is, with record low unemployment and consumer budgets, looking really healthy. A lot of stimulus was just thrown again into the Australian economy, and some people are already sort of wondering how's this play out now over the next few years. But then you throw supply chain issues, commodity prices spiking. It's I'm an active manager, so I'm talking my book here, but I don't think it's the right time to just be a passive index investor. I think that time for stock picking and active investing is really going to come to the fore.
Yeah, there are so many moving parts at the moment, aren't we? And of course, throw in a federal election at the same time. So that's also something we've got to consider. Perhaps potentially a change of government. We're going to get a lot more policies clearly over the next couple of months. Hey, Claude, so interested to get your summation, given that we're at the end of the quarter there. We're just talking about the performance, certainly locally, pretty much led by, I guess, financials and materials. No surprise there, particularly as far as materials and where commodity prices have gone.
Yeah, well, exactly. I think what we're seeing is that the short-term beneficiaries of inflation, really, whether that be commodity price or more in the financial realm, making it easier for people to pay back loans. We're seeing the short-term beneficiaries of inflation do well in the near term, basically. But of course, eventually, if you have enough inflation, say in commodities, eventually that can start destroying demand, so that those good times don't necessarily go on forever.
All right, well, let's focus on the here and now, and the first half of the show. I tell you what we're covering. Genesis Plus, Comms Group, Cobalt Blue, 8 Common and Field Solutions. But first, of course, we want to take a look at the stock of the day, and that is Domain. It's on the acquisition trail, snapping up real estate campaign management company Realbase for around $230 million, funded initially through a $180 million cap raise. Company Chief Executive Jason Pellegrino telling ausbiz a little earlier that the move strengthens Domain's position as the leading provider of end-to-end agent workflow solutions.
Space is a fantastic business in the technology space that actually helps agents with key parts of the campaign marketing and bringing properties to market and helping vendors sell those properties, and is an ideal fit with Domain. It fills in a number of product gaps that we have in our vision of an end-to-end product solution for agents. It helps us accelerate our vision of our property marketplace of providing an end-to-end solution for all agents and a wonderful experience for consumers.
How quickly will be earnings accretive? Straight off the bat, or do we have to wait a period of time for the synergies to go and start kicking in?
This deal has been done on an earnings accretive basis, both in FY22 on a pro forma basis or for the period of time between closing and year end, and will be earnings accretive in our first full year of ownership as well.
So when
All right, so that's the view from Jason Pellegrino. They're just taking a look at the share price and that's its performance. That was in fact yesterday, I believe. All right, let's get some opinion of Domain. Claude, let's start with you then, because it comes at an interesting time in the property cycle as to where we're at with the view of clearly interest rates on the rise, and we're already seeing some of those prices come off and how that's affecting stock levels.
Well, I guess there's two questions. There's one is what do I think of Domain, and then two, whether this transaction announced today would change my view of it long term. I guess I'll start with the second one. It wouldn't change my long term view, although I have to say this transaction is interesting food for thought. On one level, it shows the kind of way that Domain can grow its earnings by getting more of that wallet share from its existing agent sort of customers. And I think that makes sense as a strategy, because in terms of actually growing, the number of agents that use them, Domain and REA Group are already sort of like, they're the must-haves in the property advertising sector. So I think it makes sense to try to increase profits that way. So I like that strategic thinking. Then the second question is, does the price make sense? They're saying they're boasting about 20.5 times expected FY22 EBITDA. So I feel like this is quite a high price. That's excluding synergies. But, there's definitely some risk in the price you pay. And I don't think that it's an amazingly good price. I wonder, for $180 million, could they have built this kind of functionality themselves? But I don't think it's terrible either. And, I think that the overall strategy makes sense. Then when it actually comes to Domain, I think it's a great quality company. And what I like about it in the current environment is that, whilst an inflation cycle can definitely lead to a volatile property market because it impacts the amount that people can borrow, over time, over the long term, land and property is one of the things that does tend to retain its value, right? So inflation means the dollar in your bank account, in the bank account is going to buy fewer burgers, as Warren Buffett would put it. But actually, there's no more land, and the houses are generally, especially in certain areas, are going to keep going up in value, which just means that the price of the asset that Domain and REA Group are helping people sell, that continues to go up strongly, and that means ultimately that their ability to tax that transaction has something to do with the actual size of that transaction. So as long as that keeps going up over the very long term, and I think it will, they're going to be able to put up prices, which basically means that even though inflation can be bad for a lot of businesses, and I'm not saying it's a good thing, a business that can put up its prices continually is going to do better in the long term. So for that reason, I'd say, Domain is probably a hold or a buy. Personally, I think REA Group is the better of the two, just based on past growth rates and the current multiple of earnings. But I think that they're both solid quality businesses. For me, I'd probably put Domain more as a hold, but it's a good quality stock.
All right, that's the view of Claude. Luke, your thoughts then? Interesting, just taking a look at the share price. In fact, in November it was at 6, and that back down now to 4.
I'll talk about that in a second. My first takeaway is Realbase is a very, very good business. I'd never heard of it, but just looking at the presentation today, the hallmarks of a quality software business, 40% EBITDA margins, still managing to achieve 20% growth this year. And that's why Domain, you're not paying a cheap price, as Claude put it. And that was my takeaway too. Have they overpaid? Maybe. We have to wait and see. My first initial thought when I read the presentation today was they're looking to drive $18 million in synergies by FY26. They need a substantial chunk of them to actually come through, I think, to make this, really a strong acquisition for shareholders in the longer term. To your point on the share price, I think it's actually a very good example of why maintaining a healthy balance sheet is always important. So you look at their last result in December, they were leveraged up to about 1.5 times EBITDA. Share price has gone from $6 to $4. Now, admittedly, it's not a lot of dilution, only about 7% dilution, but it's the sort of acquisition where if they'd had a better balance sheet, you probably just use debt to buy this. You avoid that dilution and you get much better accretion on that EPS, as the CEO was talking about before. So there's not a massive, red cross against management, but it's just a point about be wary of what you would call, fully leveraged balance sheets, because it does reduce that flexibility when you may need it most. I agree with Claude's final point. I actually think, Domain gets put next to REA, of course. REA is the better business, but this is not I don't think this is a winner-takes-all space. If you look around the world at property platforms in different geographies, it usually plays out the way it's played out here, which is a 70-30, 80-20 split. You always have that second platform nibbling at the heels. I think Domain just continues to do that. It'll grow with property prices and general growth of the economy. It's not massively expensive, so I would say it's a hold. And this acquisition, I think Realbase looks really interesting. Good, it's a very good business, no doubt about that.
Yeah, okay. Well, that's a double hold then for Domain. All right, let's get into your picks then. The first one coming to us from Steve on Genesis Plus. He wants to hear Luke's thoughts on the company with a rapidly changing energy grid, saying this the company could benefit. It's a provider of power, telco infrastructure, and its vision, it says, is to become Australia's leading services provider in the design, construction, and maintenance of electricity transmission and distribution and telco infrastructure. An ambitious plan. Luke, what are your thoughts?
Yeah, I felt bad for Steve when I saw this, because not only have I never looked at this business, I'd actually never heard of it. So I took a look, and I must admit, I instantly saw the reasons why Steve would be bullish on a stock like this. So integrated power and telco, engineering, procurement, construction. Normally that's not the sort of industry that would attract me. It's very low margin, very lumpy. A lot of things can go wrong, especially in a rising cost environment where you have fixed price long-term contracts into rising input prices. That said, founder continues to own 60% of the business. The highlight page in their presentations includes a slide on return on capital, which is a massive green tick for me in a business like this. Whenever you see a management team focused on the return on the capital for shareholders, I think that's fantastic, rather than focusing on revenue or absolute profit numbers where you can just dilute or acquire. They're focusing on what capital are we employing and what return are we getting on that. There are a few things I think they could have normalised or brought out of their results, which they kept in. I think that's always a good sign for a management team as well. Clean balance sheet, growing recurring maintenance revenue base, big order book, just a lot of things that I really liked. Based on their guidance, about 6 times EBITDA. I think that's a pretty fair price for a business like this. So I don't think you're getting excessively cheap, but you're not overpaying. The one thing I saw there was in their outlook statement, there was some commentary about the tight labour market and supply chain issues. They maintain the guidance, but I think they're sort of prepping the market for expect that to come in at the lower end as we're seeing these issues play out. That being said, look, I hadn't looked at it until yesterday, so I can't come in here and say buy. But Steve, if you own this stock, I see no reason on what I was looking at to say sell it all. I think it's a definite hold and one for the watch list. If someone wants a stock like this, it's in that utility space, defensive space, and ticks a lot of boxes for me.
All right, on the watch list, a hold from Luke. Claude, were you aware of Genesis Plus before we brought it up?
I was aware of it just because I like to look at companies that are involved somehow in renewable energy, and these guys have as one of their strategies, not saying that this makes it a buy, but it's just like one of their strategies is to try and get more work doing the electric connections for renewables to the grid, which is obviously, in my view, probably a potential tailwind in the sense that if we have more, solar farms popping up around the place, wind farms, then, that probably means more work for these guys. However, that's not enough to say that it's a great business. And in fact, I think I would probably come over a little bit more negative on this one than Luke. I think he makes some good points and it looks like a decent company. It's nice to see it's profitable, but this kind of business can be exposed to risks to do with, if a project goes bad, something goes wrong, they're unable to get it done. I wasn't able to figure out how badly they're exposed to those risks, but I did note that in their prospectus it did say, one of the risks or one of the factors that you had to keep in mind was that whether there was going to be a continued availability of skilled labour necessary to successfully deliver on project commitments. And obviously we have a fairly tight employment market. There's a lot of commodity boom stuff going on as well at the same time. And I would argue that probably the labour pool, for even though it's got, say, nothing to do with them, the labour pool for, an iron ore mine or general support for that still is going to pull on the same kind of pool of people that Genus Plus might. So I do actually think that will probably tighten for them. And I think that whilst, that doesn't mean this is a bad stock long term, I do think that that's probably going to be a short-term headwind, that would probably make me very hesitant to hold shares right now. Now, that could be wrong, but yeah, look, I feel a little bit concerned about how it's going to be for these guys going into the current environment, whether they're going to be able to, manage a situation where it's possible that their employee costs are going to be going up over time, and can be a risky situation.
Okay, so you're pretty much avoiding it at this point.
I would avoid it, but I wouldn't want. I'm sort of with Luke in the sense that I think that overall this looks like a reasonable quality business in this space. It's not really where I tend to go fishing. I tend to prefer, more tech or even medical. Something that has really solid demand and higher margins is generally more my cup of tea.
All right. Well, let's try the second one then. See whether you like it. Comms Group. Ben, wanting to know your opinion on this IT services provider to the SME space. He's fairly comprehensive in his analysis of this, saying current sales mix, the majority there being voice, data services making up the remainder essentially, saying it floated in 2017 as an IT service provider, rolled up 5 separate businesses, but he says it appears the CEO overpaid for those businesses, missed guidance, and then the stock went bad essentially. Then 2019, Peter McGrath, who ran NextGen, he took over. And he's saying, look like it's one of those situations where no one is interested because of how badly it went at the start. So, Claude, what are your thoughts?
Yeah, so I'm more favourable on this one. I do not own shares myself, but actually this is the kind of thing that you could find me playing in this kind of space. I think that the questioner really put their finger on it then. It is a turnaround. We are looking for, Peter McGrath basically to be able to turn around this business and make it profitable, generate free cash flow, etc. Now, of course, part of the thesis for this kind of messy turnaround situation is the fact that, basically Peter had previously run a business called Ecom where he basically did a successful turnaround there and then sold it to Singtel. So I guess the question is, can he do some sort of similar thing himself? Now, the real direction that they've been taking the company more recently has been basically to be a managed service provider, as I understand it, of Microsoft Teams, which, basically they sit in there between Microsoft's not going around to every single business and be like, here, let me set you up with this. They use partners like these guys to sell on Microsoft Teams plus any often, telco services and connectivity that's needed to go with that. And that's where these guys have been fitting in. And obviously, with the pandemic and everything, that's only accelerated the growth of Microsoft Teams. Now, if we actually just look at the stock itself, I guess there was a couple of points I wanted to make. Like, first of all, we've seen a little bit of director buying on market, which I always like to see. That puts it on the list for me. But second of all, I think that you've got to be a little bit careful here with people who will look at, say, the underlying EBITDA and use that to value the company or to say it's cheap. And I'm not sure I always agree with that, because what you see in the most recent report is that they had a EBITDA of about $1 million and the underlying EBITDA was about 1.9 million. But what that excludes is share-based payments and business acquisition and integration costs. Now, if this company is going to continue to roll up little businesses, then those acquisition costs will be sort of a recurring cost. And if that's part of your growth model, then you've got to take that into account. And then, of course, share-based payments I generally count as a real expense. Having said all that, to the extent that I can without actually owning shares myself, I actually think that the risk reward on this company is favorable. You have aligned management with experience that, you know, could well make it work. And then B, you have this situation where it's sort of getting close-ish to break even. So, you know, or at least at an EBITDA level, it's profitable. So for that reason, I think that it can fund its own growth. And like I would back it. I don't own shares, and it's a little bit high risk for me at the moment, but it's actually on my watch list, and it's one of the stocks I've been considering. So call me a hold, but I'm quite positive, or a buy, but I'm a little bit too cautious to actually buy myself.
Fair enough. Nothing wrong with being cautious, Luke.
Look, Ben knows this company pretty well. You can tell that from his paragraph intro. And I think he's hit on the important points, which is focusing on the new CEO, Peter McGrath, and his history. And he's come in, put some of his own cold hard cash into the business, not just incentive options and you know, the way some executives sort of get their alignment. The reason why management's so important in a business like this is when you have an acquisition-led business, you need to make sure they're buying the right things, they're paying the right prices, and then Claude alluded to it just then, is that when they present their results to you, acquisition-led businesses often have to refer to underlying results because you have all these moving parts and restructurings and acquisitions and, you know, advisory costs, legal costs. Of course, that's all unaudited, and so you're relying on the management team's honesty and truthfulness to actually exclude the correct costs and not maybe sneak some things in that they shouldn't. So I think he's down the right track of highlighting, you know, Peter McGrath has a good history, he's got some real money behind the business, and it's a bit of a back the jockey, you know, rather than the horse, because these are average businesses, and that was one of my notes here, is that the history of these IT managed services business on the ASX, it's not pretty. Like, you go back and there was PSZ, which became Tesserent as it is now, and Tesserent's running the same playbook of just acquisitions and wait and see what happens. RXP bumbled along for 10 years before being bought out at the same price it was, you know, a decade previous. Melbourne IT, you know, went effectively to zero and diluted holders the whole way. You got a couple more similar to Comms Choice now, like Cirrus Networks and MOQ. So just like they're not great businesses. It's very low margin, very competitive. But that being said, it's cheap, and a good CEO in that industry can make the right acquisitions and position the business either to be acquired itself, which, you know, there was an article in the AFR that Quadrants had one of their managed IT services just get acquired by I believe a Singaporean company. So that may be the end game for something like comms. For me, it's a hold. I think Ben's done a lot of work, and I think he's highlighted the reasons why you own this business. And that's now your investment thesis, Ben. Just stick with that. Make sure Peter's executing. One other note I did have for any sort of acquisition roll-up, always look at the earn-outs on the acquisitions. So I went and had a quick look at their latest result. They acquired a business called Next Telecom last year. It didn't hit their earnings earn-out guidance, meaning that you know the results of that business didn't match the what they thought it could when they set the earnouts in place. And they acquired a business called Switched On, which has a potential revenue earnout coming up in this full year result. So just watch that, because if they're executing and reaching those earnouts, it means the acquisitions are humming and they're doing well. If they're not, maybe there's something going on under the surface. So just watch those ones moving forward.
Comms Group, a double hold. Let's move on and go underground. We're going to look at Cobalt Blue. Eugene wanted to know about this, saying it's beginning underground development work at its Broken Hill Cobalt project, set to become one of the world's largest ethical suppliers of cobalt. saying the majority at the moment coming from the DRC in Africa, where ethical environmental standards are poor. Look, he's fairly comprehensive in his analysis of this. Luke, we need to pick up the pace, so let's get straight to it. Cobalt Blue.
Yeah, I'll be quicker with this. It's not my style of investment. I actually saw the CEO present at a conference a few weeks ago, and I was pretty impressed. The viewer highlighted the main appeal to a business like this, which is 70% of the world's supply of cobalt comes from the DRC. There's a lot of ESG concerns, and so Tesla and a few of the auto manufacturers are seeking out alternative supply, and that's where someone like a Cobalt Blue is hoping to come in, really painting that green ESG picture around themselves, but sort of fair enough to a certain degree. I don't know a lot about mining, I must admit, but the things I always look for, it looks okay. Like, relatively low capex to bring this mine into production of about 500 million. They could easily find debt funding and a bit of equity to get that up and running. At current cobalt prices, about $37 a pound. You're talking NPV of 1.3 billion. Today's market cap's 240. That said, if cobalt goes back to where it was for the last decade, you probably don't have a feasible project somewhere in that sort of $15 to $20 mark. So if you want a pure play cobalt based on ESG or electric vehicles or whatever your thesis may be, I think this is a good way to do it. For me, I just don't like taking that bet because you're so leveraged to that commodity price. So it's not for me, but for someone who wants cobalt, I actually think this is a pretty decent way to do it.
All right.
Because most cobalt is actually just a byproduct of a copper mine or something else. So this gives you pure play cobalt without having to worry about other commodities.
All right, Claude, your thoughts then?
I'll just add on to what Luke said, which is to say, I agree with what he said, but I think that the way that one should look at the stock price of this company in the short term is it's just a sociological phenomenon right now. We have a super hot battery sector. Obviously, already we're in the midst of this massive change to try and reduce fossil fuel and increase use of batteries, which cobalt's used in batteries. On top of that, of course, the Ukraine situation has just made that even more important. So a lot of what's happening right now is it's just a way of expressing that excitement. The reality is these guys are saying that they are looking at late 2025 as when they're going to be doing production, right? Now, that's first production. Now, that's if things go to plan. Sometimes they don't. That's late 2025. Right now, this year, they're focusing on doing a demonstration plant that they want to run 24/7 samples, start showing people. Now, I hope this mine actually happens. It seems to have support of the local people. It seems to be a great solution to cobalt supply, which is going to be important. And they have some sort of investor from LG International, which is, I think, the South Korean battery maker kind of thing. So they've got total potential. But right now, until really they're much closer to production, this thing is going to be trading on that sociological wave more than anything else. So I'd look at it as a bet on that. Right now, obviously, we've had a massive run up. It could run up further, but for me, it's like a little bit too late in the sociological hype around batteries. And so I'd be looking to maybe revisit it closer to 2025 if I invested in mining producers, which I don't really.
Yeah, we've certainly seen the run up in the share price just over the last month, but the cobalt price pretty much almost doubling in the past 6 months. All right, let's move on. 8 Common. Kira wanting to know about this. It's a platform that supports organisations in the management of their credit cards, business expenses and travel and such. Claude.
Yeah, so this one is one I've followed for years, and I'm sure Luke will have some gems on it because he knows it well. But basically, they have 2 main products. One is this Expensate software, which mainly is focused at government. It does have some private clients, for example, Woolworths, but that is an expense management platform. So, when a bureaucrat has to go on a travel trip for whatever reason to go and consult with stakeholders, Expensate can be used to manage their expenses. On top of that, they have a new product that they've been pushing called Card Hero, which is essentially like a reloadable card, and it, of course, feeds into their expense management software, but that's a separate product. Now, I think that they've been making good progress with both of these products. I remember when they announced Card Hero a few years ago, they actually are slowly rolling out, new Card Hero functionality. They just the other day, about a week ago, announced another not-for-profit. I think it was West Haven, which is using Card Hero Expense 8. Meanwhile, they've got a good agreement with the government for Expense 8, which should see that grow. However, my reticence with these guys is every time they seem to get some share price momentum, they always use it, or they've so far always used it to raise capital. And so that makes me think, oh, when are they ever going to get to free cash flow positive? Look, right now, I don't own shares, but of the ones we're talking about on this show, it's probably the one I like the most and closest to buying. I think it's an investable company. We've seen a little bit of director buying lately. The share price is in a little bit of in the doldrums, as can happen when you have these non-profitable little micro caps and you have a volatile period. People are very worried about them. I think this one is a survivor, therefore it's investable. Therefore, it's actually one that I'm actively looking at, and I wouldn't even rule out buying some shares myself again. I've been a shareholder in the past. But when I see that strong run up, that's when I'm thinking, oh, is there going to be a capital raising?
All right, well, that's a vote of confidence. Luke, your thoughts?
Yeah, for disclosure, I own it with Merewether Capital, one of my higher positions too.
Right.
So Claude's done a good job outlining the business. One of the things I really like about them is they, late last year, won a whole of federal government contract for their expense solution. And I think when that happened, it really de-risked the future of this business. So you run the numbers on what that contract meant for them. They're going to bring in probably about 6 to 8 million annualised recurring revenue as they ramp up all the different government departments. But Claude's right, they have used spikes in the share price to raise capital in the past. I sort of hope that won't continue because the government contract also comes with some really solid implementation revenue. So, because one of the problems that a lot of businesses have, even software businesses, is they can consume a lot of capital in that real startup phase until you get that user base on the platform and just, transacting every month. But these guys, because of that implementation revenue, that capital sort of sorts itself out as the government's essentially paying you to roll out your product and onboard all of your users. I view the Card Hero stuff as a bit of blue sky potential, but admittedly, as Claude pointed out, they're getting a few runs on the board, particularly in that NDIS space, where I think there's a genuine use case for that technology, where you have disbursements of NDIS funding, and using a digital solution just allows that to be maintained, dispersed correctly, make sure there's, unfortunately we've read all sorts of articles about fraud in the NDIS and things like that. So I really like this business. I think the next couple of quarters, I'm hoping, will really start to show that inflection point where the government contract's ramping up. They are exposed to travel, as Claude alluded to. Like business travel goes through their system. They book trips and modules through that. So I think a lot of things are now lining up for this business. Next couple of quarters are important, but I'm pretty confident they can start kicking some goals.
All right, that is 8 Common, certainly the favoured stock to date on the show. All right, our fifth one is Field Solutions. Sam wanted to know about this one. It's a telco provider of rural, regional, and remote Australia. Vision of being Australia's largest rural and regional telco provider, in fact. Luke?
I had this one on my watch list for a long time, like a couple of years, and I could never bring myself to really pull the trigger on it because I found the assets interesting, rural telco coverage, and you're not competing with the majors, and you can carve out a nice little asset there. But I always thought it'd be low growth. You're very reliant on federal government funding or state government funding as well. I must admit, I went and had a look yesterday. The share price has done very well on a longer chart. That's it there. Management's done a really good job of executing beyond just becoming a tower asset business, launching their own mobile service, extending to data centers, cloud products, some IT managed services, but all focused around that rural and sort of regional areas. And I think that's you can carve out a genuine competitive advantage, marketing yourself as the telco and IT provider for rural Australia. The only negative I see is the valuation. It's even at the high end of their guidance, they're talking 24 times EBITDA. Now, they're building out an infrastructure asset. You only have to look at Unity Group right now to see how much the market's willing to pay for a solid telco infrastructure asset. So, you could possibly argue, look a couple of years in the future, that's a pretty reasonable price. For me, on a run like that on that chart and 24 times, I would hold it if you're there, but I would just put it on your watch list otherwise and maybe wait for a bit of a pullback.
All right, okay, Claude.
Yes, so similar conclusion for me. I think that it's not one that I'd buy right now, these things tend to go in fits and starts. They've had like an inflection point where they've burst into profitability. I think 1.6 million they made in the last half. Now, if you annualize that, then they'd still be on a PE of like 40, something like that, which is fairly high. So let's see how they go. Having said that, I do think, this is a $130 something million company. It's definitely one for your small cap watch list. My one caveat, my one concern is that they have a whole range of different revenue streams. They personally divided up into government, business, enterprise, residential, and managed services. I wonder, I guess, like the thing that it sits under is rural. But typically rural telco sectors has been difficult to make a profit in, which is why you've needed government subsidy to, have services to those areas. So I guess they're going around and cherry picking where it makes sense, where there's a customer that can pay. That can work for a certain point, but does that go on forever? Is this the kind of group that can just keep on growing and compound for 10 years? I would say it'll be a tough gig to do that. So for me, it'd be like, I guess, a hold at best, just because I feel like it's probably got its uplift, its growth period, and then it's going to plateau as a business.
All right, that is Field Solutions. Let's sum up those 5 stocks plus stock of the day, which was Domain. Now, both essentially have a hold on it, but both prefer REA Group. So that is the preference there. Our first stock, Genus or Genus Plus. Luke talking about low margins in a rising cost environment. Does have a clean balance sheet. He's got a hold on it. And Claude's saying essentially not now, but he does have a watch on it at this point. Comms Group was our second one. Bit of a messy turnaround. It does involve Peter McGrath, which they both like. He does have a good history of turning these companies around. In fact, Luke's summing up by saying you're backing the jockey rather than the horse. So both have a hold on that. Cobalt Blue. That is obviously in cobalt mining. Claude makes the point that they're not likely to come online until late 25, so he's going to revisit it at this point. And 8 Common, well, this is favoured by Claude at the moment. He's got a buy on it, and in fact, Luke owns it in Merewether Capital there. He's reassured given that it's got a government contract, so which he says essentially de-risks the business. And finally there, Field Solutions, both watching that one. All right, let's move on to our second 5 as such. In fact, just before we do that, Call's High Conviction Fund is up and running. You can catch up on the first committee meeting online ahead of the next episode, which will be out next Tuesday, in fact. Let's have a look at how the portfolio stands. It's an equal allocation to BHP, Macquarie, Mineral Resources, Steadfast, Aristocrat, Ordinate, CSL, NextDC and Universal Store. Then half units to Qantas, Frontier Digital Ventures, and at 20% is currently being held in cash. So keep sending in your requests and keep the call switched on to see which stocks our committee will be looking at next.
Grab a beer, grab a glass of wine, because this is where we just gossip.
It has been easy to get this bull market wrong.
Cheers to you.
Have a great weekend, everyone.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
All right, let's take a look at the next 5 stocks. We're going to take a look at Cryosite, Adore Beauty, Quorum, My30box and Redflow. Let's get into it. And Cryosite, providing outsourced clinical trials, logistics services, manages the entire clinical trial supply chain, essentially. Luke, thoughts?
Yeah, Claude and I got a bit of history with this business. I did a lot of work into this stock years ago and nearly bought it at 50 cents. And, it took a long way down from that point. So luckily I held off. The core business used to be cord blood storage. So basically what this was is that when a baby was born, you could opt to take blood from the umbilical cord, which has stem cells in it, and they would put that on ice for 25 years. And the economics of that business should be brilliant. It's people giving you cash up front for, you know, a 25-year service. So, you know, the cash flow was just fantastic coming through. The problem they had was they were dragged into a price war with a much, much larger private peer, and effectively were forced out of that business. They just couldn't keep up. Now, in doing that, in taking umbilical cord blood and storing it, you have a cold logistics network, and the business started to leverage that into clinical trials and drugs and you know, things that need to be transported around at low temperatures. And I must admit, like, it sort of fell off my radar for a few years there. Going and having it came up about a year ago, and I thought it looked interesting, but it still had a turnaround was still going. Looked at it again yesterday, and I actually think it's starting to look interesting again. I give management full credit. It's taken them a few years, but I think they've gotten that logistics cold storage segment, you know, really up and running to the point now where it's the main part of the business for sure. The points I had from it for Harry, who sent it in, you take one look at this, the profit and loss accounting of the business is a complete mess because of the way they have to, through the accounting standards, have to account for that cord blood business. Mm-hmm. So they record revenue, but absolutely no cash comes in because they received that cash 5 years ago. So my advice to Harry is completely ignore the profit and loss. It has almost no value for this business in analysing it. You have to look at the cash flow. And you go and have a look, and for the half, it was pretty impressive. Like, you know, 1.9 mil operating cash. They benefited from some working capital movements, but even if I adjust that out, it's sort of like 1.2 mil, a bit of capex for 700,000 free cash flow. That's pretty good for 20 odd mil market cap. You know, I think there was 6 odd mil cash, 26% revenue growth for that core business, 32% profit growth. So I put it back on my watch list after this yesterday, and a bit like the first stock, Genus Plus, I'm sort of, despite knowing that business quite well, you know, from looking at it years and years ago, I need to do a bit more work getting my head around it to come and say buy. But Harry, if you're there, I would hold it. I think management's done the hard yards over the last few years, and I think it actually looks pretty interesting right now.
All right, yeah, Claude. In fact, I should note that Harry did send this in. He says it may have some tailwinds behind it. Is it undervalued? What am I missing? He says.
Yeah, well, I think the thing that you're most likely missing is that people like Luke and I have got long memories. So you've got some of those people in the market that just look at it and they're like, brings back some sort of, in my case, trauma. Because unlike Luke, I actually thought that it would make a go of this cold blood storage, and basically halved my money on the stock. So when it comes down to it, you know, the story has changed now, and Luke is correct that they've moved more into the clinical trials and then logistics side of things, which I think was 4-point-something million I've got in front of me versus their whole revenue of 4.6 million of their entire revenue, which is 5.8 in the last half. So that's the story now. That's the business now. And look, I kind of like it because I could imagine that these guys might be involved in transporting and storing vaccines, especially these mRNA vaccines. So, like, down the path, we may have more and more mRNA vaccines, not just for COVID, but for other things as well. And so far, it seems these vaccines need to be stored at very low temperatures. So if they start becoming more of a feature of our society, then I think that these guys will do really well and they'll be perfectly positioned. And that's why it's interesting to me. So, yeah, that's the pitch for it. I'm not across the line yet, but look, I think it's very interesting.
Okay, great. That is Cryosite. All right, we better pick up the pace. We are falling behind. Claude, Adore Beauty. And of course, it's online beauty cosmetics retailer. It is in the discretionary retail sector, so that's perhaps a potential problem given the overall environment at the moment.
Yeah, well, let's save a little time on this because we did discuss it a couple of months ago. But since then, we've had the results. The company showed negative free cash flow of about 3.5 million for the half, but then they reported a profit of about 2 million for the half, which still isn't great. Now, to put that in perspective, they had revenues of 113 million and a $2 million profit after tax. That's very, very thin margins. And on top of that, you got negative cash flow. So that's a bit of a red flag for me. Adding to it, you have the fact that this was a super hyped float, and I generally don't like to invest in companies that do a super hyped up float. and then the share price crashes, which is exactly what happened with Adore Beauty, because ultimately it makes me think that, the investors have been poorly treated, and then why would that encourage me to become an investor? So that's, strike two. And then, of course, strike three is, as you alluded to, I just don't think, I'm not going to be buying an online business right now. These guys have just had a massive free kick with COVID, closing down physical stores, etc. Of course, that's going to benefit them. We're seeing advertising costs across the board. We're seeing these companies have to spend more and more on paid acquisition. So for me, I would just avoid it.
Okay, that is a big avoid. Luke.
I actually think these guys were the pick of the e-commerce results, but that's the best of a bad bunch. They were all pretty ugly, but I must admit these guys were probably the best one. They do a really good job of driving customer loyalty, and I think that's really important. Claude's right, e-commerce is going through a really tough time right now. And the main problem with e-commerce, and I think the market has completely rethought the way they price e-commerce businesses, is that, even once you bring someone back to your website, I know what I want to buy.
Yeah.
I'm one Google Chrome tab away from typing in that product and doing a quick price check and potentially buying somewhere else. And it's that ease of churn just makes these businesses, they talk about returning customers and loyalty and average spends and all that sort of stuff. But when that ease of churn is just so high, it's tough for these businesses. And I've said it before, obviously Amazon dominates e-commerce, but the reason why, it's the subscription model. I've already paid my $60 Prime subscription, so I'm going to use it.
Yep.
I need to get my value back. So look, some of the there were some positives to it, don't get me wrong, but Claude highlighted the main issues that every e-commerce guy saw, which was profitability suffered because your marketing and expense costs had to really grow faster than your revenue to continue growing.
All right. Okay. So you're avoiding it at this point.
I would definitely avoid it. Yeah.
Okay.
Get a better price for that one.
All right. Quorum is our next one. Software company, hardware reseller. Braden wanting to know about this, saying quarterly results weren't amazing, but what does that mean? Is there potential for the company still, Luke?
Claude knows this one better than I, so I'll be quick.
Yep.
Like a lot of micro caps, when you go through a restructuring or an investment phase, you generally struggle to find love on the market. Your share price sort of bumbles around, and you have to wait until you see that recovery in the numbers, even if the underlying business is starting to do well and the growth starting to come through. They report to be roughly cash flow break even, but there's $2 million in R&D grants in that. So I think at a organic or normalized level, they're still a little bit loss making. Management are targeting 15% revenue growth, fell short of that in that last result. They're investing for that growth, so I think the market is sitting back and saying, let's see it before we buy in. The main positive I actually see with it is that I know this business, or I've known it for a few years. I think they've finally cleaned up all these legacy issues that they had. So they had weird segments, like an e-commerce segment, a real estate segment. There were legal disputes, a software dispute. There's a lot of moving parts that were taking management's focus off trying to be just a pharmacy software company. That's all gone. So I think the positives you really got is you now have a fully focused management. They have to execute. To be honest, I probably have the same view as the market, which you see with the share price, is you can sit on the sidelines and wait for the execution to come through. So
all right.
I'll just hold off on that one.
Okay, Claude.
Yeah, so I own shares in this one, but it's not been a success for me. I bought them before they ran up and then held them, believing that they can deliver on those goals, but they haven't delivered. And I think the key development we've seen is basically the company has spent in hiring more people and in order to get growth. Now, they have had a little bit of sales increase from that sort of core healthcare software. So the pharmacy software businesses is PharmX and Coram Clear. They're the packages there. Now, PharmX is the one that they bought not so long ago, and that's still growing. However, that was partly hampered by something that wasn't their fault, which was that Pfizer changed distributors from DHL Healthcare to somebody else. DHL Healthcare had been on the PharmX platform. The new one wasn't, so they lost some volume because of that, and some of that will actually impact the next half as well. Mm-hmm. On the plus side, we really saw an instantly fast response from the executive chairman, who's basically gone in and come in and taken over as CEO because of this. We've had a year now. We haven't seen the growth that we wanted to see, and I guess there's a number of reasons for that, and they didn't get massively into it. But the CEO is gone, and now the executive chairman, who's a major holder and has put his own hard cash in this, he is taken over, and he's just going to focus on growing the Farmex business, which is probably the right strategy because that's the business that was kind of growing anyway. That's already growing. He just wants to accelerate that. The second step of the turnaround will be to try and reinvigorate growth into this Quorum Clear and this Quorum Enterprise stuff. They've got a bit of a cybersecurity offering. That side of the thing where you're, rather than just connecting pharmacies with the distributors, which is what the Farmex thing does, the other side of their software is more like, the pharmacy having their dispensing software that they're actually using in the pharmacy. So that's still been on ice. That's been a disappointment. We need that to grow for it to really be a success. For now, I'm still holding, but, as Luke says, the wiser path now would probably be to wait to see if they can start delivering.
All right, Coram, a hold there from Claude. All right, just got, don't have a lot of time, but we'll rip through the last two. Claude, my foodie box, this is the Perth-based company providing meal kits, essentially, that are preservative, hormone-free and sustainable.
Yeah, I think that I wanted to take a little bit of a zoomed out approach to this and just get people to think about how many of these, my food box companies, do you think can sustainably be in a market? And then how many can profitably be in a market? Is this a situation where we're going to have as many different food box companies as we have, corner stores? Or is it more likely going to be supermarkets, where in Australia we essentially have IGA, which is all of those independent ones, plus Woolworths and Coles? I think it's going to be, if they ever get to profitability, it's going to be a fewer number of bigger ones, because it's obviously a scale game, right? You've got this distribution network, you've got to buy in bulk, you're sending out the meals. So my foodie box is a WA-based one, and I just thought I'd do a little bit of a market comparison. Look, here are the other companies. They're in WA, they're going to go to Sydney, Melbourne. So that's going to put them up against Dinner Twist, Dinnerly, Every Plate, HelloFresh, Marley Spoon, Pepper Leaf, Thomas Farms Kitchen, and You Plate It, among others. There's also You Foods as well, which is a bit different, but same idea. And then if you go and look at the price, my food box I looked at 3 meals per week for 2 people. They're $13.30. Dinnerly is the cheapest at $7.25 per portion. Marley Spoon, which I love and we use, comes in at $11.50 per portion, and then HelloFresh was a little bit more expensive than that. Oh no, sorry, a little bit cheaper than that, about $11.30. So the HelloFresh and Marley Spoon are very similar there, as you'd expect, because they're the big players. So look, I just avoid it. I hope that I've just made a point with that competitive analysis.
You have indeed. Yep. All right, Luke.
Yeah, look, even if we weren't short on time, I'd be quick with this one.
Right.
To sum it up, I actually tried to look up for my foodie box and found my food bag. So, there's another one listed on the ASX.
Yeah.
Maybe the competitive advantage is it comes in a bag
Well,
instead of
only
a box.
recently listed, but yes.
Yeah. This is so early stage. It actually shocked me that it managed to get a listing away.
Right.
2,000 subscribers is nothing. 2.5 mil revenue, but of course, that's because you're charging $10 odd bucks a week across that.
Yep.
The proceeds from the IPO hadn't hit the bank when they reported their half year results. So to the end of 31 December, there was $45,000 cash in the bank. Your average corners, like Claude was talking about your corner stores, they have more cash in the bank on that. I don't like to say something's uninvestable, but this is pretty much uninvestable.
All right, I think that tells the story there, right there. Okay, finally, Redflow. Sam wanted to know about this. It is a renewable transition by saying it's delivering one of the world's safest and cleanest energy storage solutions, saying its battery is the world's smallest and most scalable, commercially available zinc bromine flow battery. What do you know about that, Luke?
Yeah, look, I feel a bit sorry for these guys. They've been around for a long, long time, 10, 15 years. And because of that history on the ASX, we've seen them try to get this new battery solution up and running and just haven't been successful. And many cap raises, there's the share price over a longer term. It's just gone nowhere. If this had floated last year in the midst of a battery metals theme and the world going ESG, it's probably a $1 billion business like Novonix or something like that. Look, they're trying to do something interesting, which is a zinc bromide battery, getting away from lithium. With lithium prices soaring, it may make a solution like this more attractive. Now, Technically, look, I can't talk to whether it's a better solution or not. That's just, I don't know.
Yep.
But for me, again, we talk about My Foodie Box. It's so early stage. Redflow's been around for a long time, but they're still a long, long way away, to the point where it's still negative gross margins. I mean, for a business to be negative gross margins, even after all this time, it probably suggests the technology, while being interesting, probably just isn't commercial. So,
all right.
Look, it's one where
too early.
It's too early for a genuine investor. But if you're a believer in the tech and something like that, maybe you have a punt. But yeah.
Claude?
Well, Luke's nailed it. So I'll just add, look, for this kind of company, if you're buying shares now, you're just speculating, and that's fine. Like, it's a story. You're hoping there's some good news to sell it as a profit. If you look at the long-term history, you see what this stock has done to shareholders' money. And if you want to come at it as an investor who's trying to really value the company and buy something undervalued, then this is just way too early stage, way years away. Like, you need to see some serious revenue. So far, the only real application that's gone anywhere with this is like using it for telco, like towers to power, or backup power telco towers that are sort of out of the way. So very, very niche, but that's not what you need. It's not like niche software can make money, but niche new battery types, it just never works, because you're competing against other kinds of batteries that have scale, so it's going to be cheaper and manufactured for less. So just got to wait if you want to be an investor in this one.
All right, be patient perhaps. All right, let's summarise where the second half of the show we've been. Cryosites there, Luke saying, well, he did like it, but yeah, the share price has come off significantly. He's watching. Claude saying he was traumatised by it, essentially. He's halved his money, but he's still looking at it. Adore Beauty, both avoiding it at this point, talking about margins, negative cash flow. All right, Coram, that's Luke saying cash flow positive. Even in fact, he's waiting. Claude owns it, but has been disappointed, saying it's just not delivering, although that is a management change. He's got a hold on it, waiting to see what eventuates in terms of that. And My Foodie Box was the next one there. Claude saying, look, it's likely consolidation. He listed a whole lot of competitors in that sector. He's got an avoid. Luke saying it is too early at this stage. And finally, we had Redflow there in battery, alternative battery. It's a zinc bromine flow. Luke saying it may become attractive, but still a long way from getting positive gross margins there. And Claude essentially saying pure speculation at this point. All right, that's the show for today. Claude, thanks so much for joining us from A Rich Life.
Thank you for having me. It's been very enjoyable.
And Luke, thank you.
Thanks, mate.
For joining us from Merewether Capital. All right, any stocks you'd like us to cover, flick us an email at thecall@ausbiz.com.au. You can tweet us at ausbiztv. And a reminder of where to find those stocks we have in the Calls portfolio, head to ausbiz.co/portfolio. And ahead on the small caps today, Annette will be chatting to uranium explorer Deep Yellow after it agreed on terms of a $658 million merger with Vimy. Managing Director John Borshoff will take us through the deal. More to come right here on Ausbiz.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.